Oil is the first invoice, not as a headline, as a quiet fee that sneaks into life and tightens what used to feel stable. A shipping lane does not need to shut down to move prices. It only needs to feel less reliable. Once insurers start charging more and operators stop taking the cleanest routes, delay becomes a cost that gets baked into every barrel before anyone dares to call a shortage. That cost is not theoretical. Someone has to sign it. Someone has to fund it. Someone has to explain it. The invoice lands in the boring places where the real economy lives. Picture a logistics desk on a normal morning. Nothing is on fire. Nobody is shouting. The quote comes back anyway, and it is worse than last week. The route looks longer. The coverage terms look tighter. The delivery window looks softer. The trade still happens. It just happens with more friction and a higher all-in price. Reuters has been tracking how markets react when that kind of friction shows up. Uncertainty gets priced first. Oil tends to carry a premium, the dollar often firms, and equities stop leaning forward. That premium does not stay inside oil. It leaks into inflation expectations, and inflation expectations are where rate cut dreams go to die. When the market stops believing money will get cheaper soon, growth valuations feel the shift immediately. AI gets clipped there, even if nothing changed inside the labs. A sell-off does not mean the technology failed. It usually means the future got repriced. AI is valued on earnings that arrive later, and later becomes less valuable when money becomes more expensive. That sounds abstract until you watch how desks actually behave. When money stops feeling cheap, investors do not ask whether the model is impressive. They ask what they are paying today for cash flows they might not touch for years. The excitement can be real, and the price can still come down. Capital economics put a number next to the prolonged disruption scenario, an inflation add-on in the rough range of 0.6 to 0.7 percentage points globally. The exact decimal is not the point. The point is that sticky inflation stops sounding impossible and rates start acting like it. Hormuz speeds everything up. The U.S. Energy Information Administration has described flows through the Strait of Hormuz as linked to more than a quarter of global seaborne oil trade and roughly one-fifth of global oil and petroleum consumption in recent data. When a choke point is that central, prices can move without a confirmed shutdown. That is what makes this different from a normal oil week. This is not a small twitch in supply and demand. This is a lane that sits under the whole system like a hinge. The market does not need certainty to pay attention. It only needs a reason to imagine delay. Bloomberg's market wrap language around risk-off weeks lines up with that setup. An energy premium plus less forgiving rates is a rough mix for long-duration tech, and AI sits right in that bucket. The industry can keep building while the multiple compresses. The physical side keeps this honest. AI is infrastructure that has to run inside real constraints, and the constraint that changes first is approval. When uncertainty rises and capital gets stricter, the weaker projects drift to the right and the strongest build-outs keep moving, just with more friction. In the real world, more friction shows up as extra meetings. It shows up as a request to reprice power. It shows up as a new hurdle rate that nobody wants to say out loud. It shows up as a date that slips because the financing committee wants another week. Nothing is canceled on the spot. Momentum just stops feeling automatic. You can feel that invoice travel. Higher fuel costs tighten households, shipping quotes get uglier, and budget meetings shift from grow to protect long before the official data prints catch up. Markets usually move earlier than the paperwork. That is why AI stocks can wobble in the same month AI adoption keeps spreading. The U.S.-China rivalry sits underneath the noise as the long baseline. Neither side treats AI as optional. Strategic competition keeps the push alive even when valuations wobble, which is why spending rarely shuts off cleanly. The mix changes and the standards tighten, but the push stays. DeepSeek headlines matter because rivalry changes incentives. Export controls and chip access shape the pace of scale and the market's confidence in who keeps an edge. Capability spreads and the premium attached to easy winners can compress even while the underlying technology keeps improving. Oil can fade back down. Yield can soften. The market can go right back to rewarding growth because it has done that plenty of times. Two gauges settle the argument. Brent tells you whether the energy premium is sticking. The U.S. 10-year yield tells you whether money is getting cheaper again or refusing to cooperate. When oil stays firm and yields stay elevated, the market gets stingy with long-duration growth. When oil cools and yields soften, the market can get generous again faster than it feels reasonable. 30 seconds a day is enough. Check Brent and the 10-year. If both push higher across a few sessions, treat AI exposure like it is swimming upstream. If oil cools and yields ease, assume the market can re-rate growth quickly. Come back next week and check one thing. Did Brent rise while the 10-year refused to fall? If yes, the pressure was the price of money. If no, the market probably just shook out weak hands.